Good morning, everyone. I hope you're all well. For anyone that's watching this webinar and doesn't know who I am, I'm Bernadette King, Head of Financial Services at haysmacintyre, and I'm delighted that you could join us this morning for our joint webinar with RQC Group. We've titled it Taxing Times in a Regulated Industry. So it's my pleasure today to be joined by Katharine Archer, tax partner at haysmacintyre, and Robert Quinn, who is the founder and owner of the RQC Group. So the agenda for this morning is that Katharine will be giving us an up-to-date roundup of the current initiatives to help support your business, along with any key tax considerations at this time. And Robert's going to be looking at the current regulatory issues and how regulation has been affected by the current pandemic. We would like to make this webinar as interactive as possible, so that you'll see that to the right of your screens there are some boxes. In particular, I draw your attention to the chat box and the question box. If you have any questions, please type them in the question box, and I can then put those questions to the panelists. Depending on timing, I will either do that as we go through the webinar, or I might save them all for the end. I'll play that a little bit by ear. So first of all, I'd like to hand you over to Katharine to give us a short, sharp tax update, including comments on the mini budget that was held recently. Katharine, over to you.
Fabulous. Thank you, Bernadette. Much appreciated. Thank you, everyone, for joining us. Like Bernadette says, I hope everyone's well, business-wise and family and health-wise too. It's amazing. We're now into July, and I think we were just saying before we started the webinar how used to working from home we've all become as well. So I hope everybody's feeling the same way. What I wanted to do this morning was give you an update that you will all be aware of. The huge amounts of money that the government has been spending to support individuals and businesses through the coronavirus crisis. The total bill is going to be eye-watering, and depending on which bits of the press you read, what that number will be. But I think it's in the meantime, while we wait to see how we're going to pay for this, and dare say probably our children and grandchildren will be paying for this for generations to come. Let's focus on the support that's still in place. The first one, obviously the job retention scheme. This is the furlough scheme as it's become known, and still a very vital part of the support available for businesses, for employers. The first phase of the scheme is now closed. That closed at the end of June. We're now into phase 2 of that. And that will close at the end of October. That was confirmed in the mini budget, or the summer statement last week, as Bernadette said there. So what's different from the beginning of July? A number of things really. One is that in the coming months, employers are going to have to start paying towards the costs of the employees who are on furlough, and I'll go through that in a little bit more detail in a second. The other key thing is you can now bring back those who've already been furloughed. You can bring them back in part-time. So I think that's just beginning to ease both the business and those individuals back into work, which I think is a very, very good idea. So if I just run through who needs to pay for what, and I'll just make sure I've got the right dates here as well. So for July, other than the ability to bring people back part-time, everything else continues as normal. So the government will continue to pay the 80% of the employee's salary, the pension contributions, and the national insurance as well. For August, employers will need to pay the national insurance and the pension contributions for the individuals. September, it will be the employer will pay the national insurance, the pensions, and 10% of the furloughed pay. And then in October, the last month of the scheme, the employers will pay the national insurance, the pensions, and 20% of the furloughed salary. So for the individuals on furlough, the employees on furlough, they still get their 80%. They're still entitled to their pension contributions and so forth. And you'll see over the next few months that gradually the employer is going to pay more. So it's weaning us as employers off, if you've used the scheme, weaning us off that scheme, dare I say. So great news there. What was a surprise in last week's mini budget, the budget that wasn't a budget, was the announcement of something called the job retention scheme bonus. So this is a bonus for employers and not for employees, actually, which was quite interesting. And what that means is for every furloughed employee who is still employed, and there are conditions as to minimum amounts that have to be paid and so forth, for every employee who is still employed at the end of January, there will be a £1,000 bonus for employers. So, you know, if you've had a lot of employees on furlough, then actually that could certainly add up as well. So it's just another attempt, I think, to make sure that it's not just keeping people in these jobs while the furlough scheme is available. And at whatever date they choose, there'll be a cliff edge to the end of this scheme. So just try to encourage employers to keep employees on as well. The other thing that was just in that same context, perhaps if I can mention, the other thing that was mentioned in this context last week in the mini budget was something called the Kickstart scheme. So the Chancellor is good. He's got lots of these new sort of nicknames for all these schemes that he's putting in place, and that's an attempt really for the youngsters, for the 18 to 24-year-olds, to bring more youngsters in, give them work placements for 6 months, pay them a reasonable amount for doing that, and the government will then pay the salaries and costs, overhead costs, of up to £6,500 per employee who's brought in that way. So I think that's good news. If you can find those roles within your business, I think it will be interesting to see whether, you know, post those 6-month work placements, whether some of those roles can continue longer term as well. That's definitely the government's policy, the government's plan. But let's see what happens there. Going back to the furlough, the job retention scheme, just very briefly, if I may, I think if you're up and running, you've had your employees, any employees furloughed, you're making the claims, you will have spotted that actually it's easy in principle, complex in terms of some of the detail. Absolutely vital that you get these claims right. It's been an evolution as to exactly how the scheme works, exactly how the claims work, and exactly the government guidance on this has changed and evolved over time as well. What is key, I think, is that we know, and there have been some headlines over the weekend in terms of fraud in this area. Not a great surprise. The scheme was rushed out, and I have to say, normally it takes HMRC months, if not years, to roll out any new online system, and this was done within weeks. So, you know, I think genuinely congratulations and well done to HMRC on that. It's not often I find myself saying that, but it is quite amazing given the constraints they normally work under. That does mean, though, that it's probably open to a little bit of abuse. Therefore, there will be a lot of inspection of these claims, you know, once the scheme has ended, really. So not for a second suggesting that anyone would be involved in any fraudulent claims, but actually just making sure that all the claims are exactly right, and that where you have made those claims, that the funds are used for the purposes intended. So we have seen where, and again, I'm sure it won't apply to any of you, but just really for background information, if businesses are in financial difficulty, then they you know, the money kind of is used, you know, whatever is required for, really. But it is important that the job retention scheme funds are used for the purpose, i.e. paying the employees and paying the tax and national insurance in the usual way. So yeah, I think that there'll be more to follow on that one as well. So maybe if I can just move on from there then. The other key theme in terms of tax relief that the government has allowed in the last few months is really about deferring tax payments. So tax payment holidays, and it works in a number of different ways. So there are some that are automatic, there are some that you need to apply for, and you know, some which are short term and some which have got longer term dates. So without boring you with too much of the detail of that, I think the key one for many is the VAT deferral. So it was stated very early on in lockdown phase that there would be no VAT payable, or that would be required to be paid for the quarter to the end of June. Now, obviously, we're now in July, and that is beginning to unwind. So those payments that were deferred need to be paid by the end of March next year, 2021. And important, this is the case for all tax deferrals, that VAT returns are submitted on time, and that you keep all your filing up to date. That's true across all the taxes, whether it's corporate tax, whether it's income tax, or so forth. Keep the filings up to date, even if you're looking for a bit of a holiday to pay the tax there. The other one, the other deferral, which is automatic and will be with us very, very quickly now, is that on the 31st of July, those of you in the self-assessment system would be due to pay a payment on account. so towards your income tax bill. There's an automatic deferral of that payment on account as well, due for payment now by the end of January next year, and there'll be no interest charge on that deferral if you choose not to pay it. Clients we find are doing all sorts of things. Some are absolutely making the payment at the end of July, some have done so already. Some will make payments perhaps monthly between now and then the end of January. Whatever works from a cash flow point of view. I think the government is obviously keen to receive as much cash as it possibly can. So if you're in a position, what they're saying is if you're in a position to pay, please go ahead and do it. But there's no disadvantage to you if you decide not to pay that until the end of January. So there's no equivalent deferral for PAYE. So I spent quite a bit of time already talking about the job retention scheme, and that is the PAYE break, if you like. So it is important, as I've already said, to make sure your PAYE returns are made every month, and that all the PAYE is paid, the tax and national insurance is paid there. So if you look at that and think, well, actually, what I want to do is I can't actually pay that now, you can actually apply to HMRC, and they set up a special helpline to ask specifically for time to pay corporate tax or indeed PAYE. But you must ask once the returns are submitted, but before the actual payments come due. So I think that's a very important one there. And then just for completeness, we've talked about the job retention scheme. The other scheme is the self-employment income support scheme. And this is effectively available to those with income, self-employed income of up to £50,000 a year. So it's designed to cover a whole raft of people out in the economy in the world that are self-employed and then haven't been able to work through the last few months. Obviously, being locked down, it's been very, very difficult. So the first grant for this, again, which is now closed, paying up to 80%, so it sounds similar, doesn't it? 80% up of profits up to £50,000 a year, with a limit of £2,500 a month. So you'll see for the first 3 months of the scheme, a maximum of £7,500. The second phase of the scheme is just opening, and people will be able to claim this from next month, from August, and will close by the 19th of October. So again, a short window to claim. Again, there's a bit of a weaning off of this scheme, so it will pay 70% of taxable profits, again up to that maximum of 50,000. That means, just check my arithmetic, that means that the maximum will be £6,500, just over that, again for that 3 month period. Yeah, so all of this is costing a lot of money. Bernadette mentioned the summer statement, and I thought I'd just very quickly, before I let Robert take over, talk about a few other things that were mentioned in that. So I've mentioned the Kickstart scheme. I've mentioned the job retention scheme bonus. They were really the headlines out of it. Two of the things which might be of interest to you, really, if you or any family members are looking to buy property, the stamp duty land tax threshold has been increased through to the end of January next year, has been increased to £500,000. So it takes out those for first-time buyers and indeed people who are buying second, third, whatever homes from there. So a saving of £15,000 if you're taken out of that SDLT net. Clearly a plan to sort of get people moving and moving houses and buying furniture and new carpets and all those kind of things, and the knock-on effect on the economy. So an interesting one there. VAT, reducing the rate to 5% for the hospitality sector. So you should see the benefit of that, not necessarily obviously to your businesses, but obviously when you're out and about or booking your hotel stays or whatever from there. And then the one I thought was really interesting and has been sort of slated as a bit of a gimmick really is this Eat Out to Help Out, which appeals to me, I have to say. So in August, encouraging us all to get back out and to eat in restaurants and cafes and so forth. So 50% discount up to £10 for those restaurants, cafes that decide to take part in the scheme. So yeah, clear message, I think, from the government, from all of this. They want us to be, working, and they want us to get back out there into the world a little more, which is interesting. I think then it's what happens next. So we'll wait and see what the government come up with next for us as well. can I pass you back to Bernadette now?
Thank you, Katharine. I think it's fair to say there's a lot going on at the moment, isn't there? And probably more to come as well. Whether it's, I doubt it'll be more giveaways, but certainly to sort of start clawing this back.
Yeah, absolutely. I mean, it's true. We're going to have to, whatever your political theory on the deficit is, or indeed what that number might end up being, we're going to have to start paying for some or all of this sometime soon. We expect a budget in the autumn, which Bernadette knows is the highlight of my year, obviously. But also, there's no way that's going to do anything other than increase taxes. Now, how quickly that will happen, over what period of time we're going to try and recoup the deficit, well, let's wait and see. We did see yesterday, actually, which was again interesting for tax people, probably, is the Chancellor has asked the Office of Tax Simplification, if I could say it, to review capital gains tax. And what's interesting about that, generally, I hope at least, is that it's a very, very broad scope that's been given. So it's looking at everything. It's actually saying, is capital gains tax fit for purpose? So, if I was being pessimistic, I'd say the result of it may well be taxing capital gains in the same way as you tax income, at the same rates and so forth. There's a limit to how much more tax we can get out of the income base. The headlines, I'm sure you've all read them this morning, lots of threats of, homeowners are going to pay capital gains tax on their houses. I think that would be interesting. It would go against the policy I've just been mentioning in terms of reducing the stamp duty rate to get people moving house. If we're all taxed on selling our main homes, which obviously at the moment is exempt, then it wouldn't encourage us to move, would it? So, well, let's wait and see, I think. But yes, I think the next phase is paying for it as opposed to more giveaways, I think.
Thank you, Katharine. So the second part of our webinar is looking at the regulatory issues that we should be considering as a result of this pandemic, and what have we been hearing from the FCA, and also what should firms be thinking about as we move out of the current crisis and towards Brexit, which we've heard a little bit less about, but it seems to be coming back into the fore of everyone's minds recently, which of course is scheduled for the end of the year. So for this part, I'm delighted to hand you over to Robert.
Thank you, Bernadette, and thank you, Katharine. I know in our neighborhood, we during lockdown, we've had a Five Guys open up, so the household is very keen to take advantage of the Chancellor's offer at Five Guys. Can't go wrong there. I thought today we would talk a little bit about, hey, what's been going on. It's been 4 months, believe it or not, since this lockdown, and I know for the first month or two, we all felt like it was a bit of deer in headlights moment. Now we're coming into mid-July where everyone's like, just let's take a holiday. I thought it'd be good for our clients, it's always useful for them. They want to know, hey, what are you seeing out there? What's the industry doing? What's our demographic doing? So I thought I prepared a few slides today with the help of my colleague, Matt Raver, who's on the call, to talk about what we've seen over the lockdown and what we think is going to happen going forward. Now, through the wizardry of sharing screens on GoTo, I am going to pull up some slides and cover my face with some slides here. So today I'd just like to go through a few things here of what we've seen from the start of the pandemic to now, and categorize them in several different themes. One was the orderly functioning of markets. I think the regulator was prepared for some volatility, sort of the volatility we saw in 2008, 2009, which was a major liquidity event, which I can confidently say that to date, we haven't seen that the same liquidity event and crisis going on. We did see some short selling bans enacted. The regulator has focused on operational and financial resilience, talk about BCP activation and monitoring of financial position. The FCA, obviously with the implementation of SMCR, continues to talk about what they expect out of firms and senior managers. The FCA has surprisingly been very active in publishing on a dedicated webpage all the activities that they've been undertaking and focused on. Obviously, the protection of consumers or retail clients is part of their statutory mandate. So they have been dealing with things such as financial hardship, repayment of loans and insurance. And then we've also seen something new, that advocacy, where the FCA went to seek a high court case decision regarding business interruption insurance. They noted that there were a number of different wordings in the contracts with the insurers, and they were seeking a declaration that was aimed to resolve the sort of language and the contractual uncertainty around many claims, to establish what is a business interruption, what kicks the insurance in. That was the wrong button. Let me go back to where we were. All right, briefly on the orderly functioning of markets. In March and April, I can tell you that there were a number of short selling bans that were put in place by Austria, Belgium, France, Greece, Italy, and Spain. For a number of our clients that are trading more complicated strategies with derivatives, futures, synthetics, it was a real challenge to understand each of the regulators. First of all, they put out notices that were not in English, and they all basically put a ban on short selling, but didn't interpret it in the same ways. So there were a number of queries coming through capital markets to understand what each ban meant in each jurisdiction. Those bans expired for the most part last month in May, actually two months ago, with the exception of Italy. I think it was important to note that the FCA decided not to jump on the short selling ban. It didn't see the volatility as a result of short selling, so therefore declined to participate. We also got a shock in March when ESMA announced that the reporting of short positions would decrease, the threshold would decrease to 0.1%, which was a surprise because the FCA was unable to basically put this into their IT systems and accommodate the reporting threshold change until April 6th. In terms of operational resilience, the FCA has put out a number of papers on this. They acknowledged that obviously everyone in the industry was activating their BCPs, and the focus there was those firms that were dealing with retail clients. In terms of cybersecurity, we needed to be more aware of what was going on, be vigilant about any changes. We did see a significant increase in UK government branded scams, obviously going back to what Katharine was saying. The FCA did state that firms needed to monitor their financial positions, monitor their capital requirements as well as their liquidity, to make sure that there were no sudden shocks and that any sort of events could be predicted and mitigated. In terms of outsourcing, the FCA acknowledged that, hey, a lot of firms do outsource a number of activities to different service providers. Obviously, the theme of critical outsourcing is not new, but the FCA did state that they'd expect all firms to have a comprehensive understanding of their business and in what particular parts of that the chain of events were service providers being used, and that comprehensive understanding of your service providers was mapped out. And finally, the FCA has been good on talking about the impact of staff. They have started a new website providing a blog commentary on culture and conduct, and one of those has been talking about how we supervise staff remotely. Moving on to conduct and culture and governance, the FCA was very clear that, hey, despite the fact that we're working from home, the tone from the top is vital to a firm. Obviously, in terms of being a senior manager, no longer do we have the days where, you know, you sort of, you're standing around the water cooler or the coffee machine and just sort of paying attention to what's going on in your firm. That remote management required senior managers to routinely check in with their employees to see how they're doing, and if there are any issues that could potentially impact the business. Obviously, with SMCR, the implementation of SMCR, we see the regulator really diverting from the traditional sort of norms you would expect of a regulator, where it was very transactional and very focused on the financial services component of your business, whereas this conduct and culture piece is very broad, and seems to be a moving target. I would say, though, that the FCA has been very flexible throughout this lockdown in terms of reassuring firms that, hey, we understand what you're going through, and we are trying to be as flexible as possible to make sure that we're covering the important pieces, the financial capital requirements, the protection of consumers, the prevention of financial crime, and other pieces which may be deemed as less integral. They're showing flexibility. In terms of the SMCR transitional period, they've acknowledged an extension of the deadline to March 2021 from December. Yeah, and have been flexible there. In terms of financial crime, the FCA still expects firms to be very vigilant in terms of both money laundering and market abuse. In money laundering, they have acknowledged that obviously KYC checks are going to be a little more difficult to do, so they have put out documentation saying there are alternative ways to show that you've undertaken KYC. I know I had to go the other day to the post office and pay, I think it was £12.75 to have the post office verify my passport and driver's license. That's an expensive way to get through that, but hey. In terms of market abuse, the FCA have posted out a Market Watch 63. 63 just talks about, hey, there is volatility out there, there is increased activity, and we expect you to be resilient and pivot your monitoring towards areas of risk in your business, whether it's the receipt of inside information, personal account dealing by your staff, and of course, the one that's been consistent for the last couple of years is reporting suspicious activities. I did mention that, you know, the FCA has been flexible in their response to the lockdown. They have provided a number of cases of forbearance where they acknowledge that, hey, with everybody working from home, the recording of telephone calls might be a little more challenging. They have been flexible, but do need firms to be vigilant about, hey, if this is going to be the new normal, how might we amend our policies and procedures to either record the calls from home or change our business habits so that the calls don't need to be recorded. That's obviously specific to each firm. The FCA have allowed firms to file Gabriel reports late. In terms of annual accounts and semi-annual reports, they have been flexible about allowing firms to file those when they're ready. The RTS 28, the best execution report that many firms put on their website, was delayed. And then the FCA also talked about SMCR extending the 12-week rule to 36 weeks. In terms of a transition between two senior managers. As I mentioned, they've moved the deadline back to the 31st of March in 2021, and also provide some flexibility around professional qualification exams for those firms who have permissions to deal with retail clients. In terms of the future and transitioning to a new normal, I think it's going to be interesting what we've seen so far from the FCA to see a longer term regulatory response. Whether that regulatory response is prompted by COVID or Brexit, what we do know is that over the course of the last decade or so, the European Union has been very robust in publishing reams and reams of new regulation. We know that the FCA currently is legally bound to apply all those regulations. They don't have a lot of flexibility in deciding whether to do that. And then with big pieces of legislation that we've seen like AFMD and MiFID II, that there tend to be components of it that are very difficult, if not impossible, to implement in reality. They tend to be unworkable and challenging, and that the FCA's response to those pieces typically historically have been silence. But we do know that going forward, the FCA is interested in understanding what regulations are painful for the industry and the different sectors in financial services, and which ones that we could potentially get rid of. I know that we are currently working with AIMA, and AIMA has already gone out to its members to ask about what sort of regulations can we identify that could be potentially streamlined or even removed. In terms of enforcement action, we haven't necessarily seen any increase in enforcement action yet. But as you know, the FCA tend to do a lot of supervision by questionnaires and sort of passive aggressive reporting. It remains to be seen whether the FCA is going to look at particular areas and themes in terms of enforcement. In terms of regulatory initiatives coming up in the future, we've got obviously the updating of the prudential regime. The IFD and IFR takes effect in June 2021. It is currently the position of the UK that they're going to have a parallel regime. We've seen with lockdown that obviously ESG is becoming a more and more important factor for institutional investors. We think that theme will continue to grow. The lockdown has provided a real formal break in inertia, and therefore a chance for people to sort of reassess their values and what they consider to be important. Obviously, we're transitioning out of LIBOR, and then now that AFMD and MiFID II are in place, typically we're going to review the adequacy and effectiveness of those regulations and see where there may be potentials for amendments or reform. Marketing has obviously under AFMD has been a somewhat overcomplicated topic that doesn't seem to have a sort of pragmatic solution yet. MiFID research, the unbundling of research and execution has been bedded down. We've seen the situation where research prices have come down significantly over the course of the last 18 months. And then product governance is another area where the FCA will be looking at to see whether it's adequate. And that's it from me, Bernadette.
Thank you, Robert. So I think just with Katharine's world of tax, I sound like the regulatory compliance world, there's an awful lot going on as well, and a lot for people to keep on top of and be aware of, and as ever. So I've had some questions come in for both of you. So Robert, we'll stick with you for the time being. Do you think the FCA has been more flexible for the senior managers under lockdown?
Absolutely, Bernadette. I think the senior managers obviously need to pivot to this new normal. Remember, as a senior manager, you have an obligation to take reasonable steps to supervise your area of the business. And the FCA have acknowledged that, yes, under this new normal, what is deemed reasonable is obviously changing, and they haven't really defined what that is, but they have acknowledged to a number of different ways that there is more flexibility there for senior managers to assess their situation. What I thought was interesting is the FCA said that, obviously there's a senior manager that's responsible for both compliance, well, either compliance and money laundering in the firm, your former CF10 and 11. And they made a comment about how if you can't find a replacement for them, you shouldn't be furloughing your compliance officer or your money laundering reporting officer.
Right. Okay. So that shows where a bit of where their attention and focus is then. Definitely.
Yes.
And in terms of Brexit, I did mention it in my intro and you did touch on it. Where do you see the regulations going after that? Is it too early to say, or do you have an opinion on it?
Well, I'd have to say for our client base, I mean, the idea of losing passporting was not necessarily a big deal for them. We didn't see a lot of reaction. Obviously, if you're a fund manager under AFMD or MiFID, we have flexibility around how we move the deck chairs around for who's undertaking portfolio management, risk management. It really is a political question still. We don't have any sort of clarity from the governments on where the compromise will be. Yeah. But, it's interesting because there are firms out there saying that we have a Brexit-proof solution. And, our framework in the EU is all about presence-based, right? You cannot get your FCA license unless you're physically present in the UK. It's part of the threshold conditions. So, I would be cautious about any solution that says, oh yeah, we can do this for you and make it Brexit proof. For example, if you're an appointed rep here in the UK, someone in Ireland isn't going to just appoint you as a tied agent, because the CBI is going to say, wait a minute, they're not in Ireland. So, that presence-based framework, we're going to have to see how it pans out and how the equivalence regime comes through.
Okay. And in terms of what's happening at the moment and the FCA approving things, I've got a question about, do you have any view on what the current ETA is to approve new SMCRs?
To approve new senior managers?
Yeah.
Yeah. The thing is, we haven't seen necessarily any delays, noticeable delays that we can share with our viewers about the approvals. One thing I would say is that, the service level agreements with the FCA are they're inconsistent. We've seen people get their approval in one day, and, we've seen people with the equivalent where the form has been submitted at the same time take 2 months. And the FCA has always been an organization led by those individuals in the front line, and depending on who they are and when you get them and what mood they're in, it can take, a little bit of time, or it can take a long time.
Sure.
It's
but of
frustrating.
course, yeah, and as ever with these applications, it's make them as accurate as you possibly can straight away, isn't it? So you don't get them rejected and go back to the bottom of the list.
Absolutely, absolutely. And the thing is, I think the important thing to remember with any of these applications is that the individual at the FCA that's receiving them may or may not have a sufficient seniority or expertise to understand your business and what you're doing. So I think there's a real Goldilocks amount of information you provide them. If you provide them too much information, they're then required to uncover each stone and go, what is this? What is this? What is this? So in many cases, less is more.
Yeah, sure. Okay, thank you, Robert. And Katharine, I've got a couple of questions for you as well. The second grant under the Self-Employment Income Support Scheme, you mentioned that earlier. Is there a closing deadline for claims for this?
There is the 19th of October for that one.
Okay.
So yeah, so got to be made by then. So plenty of time still. An online process as it was the first time round. Anybody needs any help, just shout.
And the other question I had for you, Katharine, was you outlined the additional support package announced in last week's summer statement. Do you reckon that's likely to be the end, or is there more to follow? Do you have a gut feel on that?
Yeah, I think it's a really interesting one. I mean, my gut instinct is that that's the end of the giveaways. We move on to increasing taxes, but I think a lot will depend on just how the economy sort of holds up over the next few months. You know, if everybody gets out to Five Guys in August, then maybe things will be better. So we're relying on you, Robert. But let's all be positive. Let's hope everything will be fine. But what shape of recession, if that's what we are in, is this going to be? So I think it does depend. But so there may be some more targeted support to come, I guess, but not as broad as we've seen in the last few months.
Okay, thank you. So that's all the questions that have come in. So of course, if anybody does have questions arising from the webinar and you haven't managed to type them into the questions box, obviously please feel free to contact Katharine or Robert directly, and I'm sure that they will get back to you with the answers. So in the meantime, thanks very much, Robert, and thank you very much, Katharine, for your time. Thank you everyone for attending this morning. I wish you a very happy and a very healthy summer with whatever you're doing with it. And I'm sure we'll all be together at some point later in the year. Thank you very much.
Thanks, Bernadette. Thanks, Katharine.
Thank you both.